Hey. And yeah, you got the clip. Huh? I'll put us in slideshow. Okay. All right, guys, we're going to go ahead and get started. We've got a pretty cool presentation coming up from Danny Wallace. I'm going to let Danny talk a little bit about his background and get a sense of some of his experiences, and then he'll bring some of those up as part of the presentation. The slides are up on Canvas under the guest speaker module. So you want to download those and take a look as you go along with the rotation. Of course, that'll help you with the guest speaker write-up and when we get the end of the term. Okay. Any question before we get started? All right. With no further ado, then, Danny, I'm going to go ahead and douse the light up here, and you're on.
Okay. Thank you very much. Good morning, everyone. Thank you, Professor Lord, for inviting me. So my name is Danny Wallace. Up until very recently, I was partner at PricewaterhouseCoopers, where I worked for almost 40 years. I spent the last 2/3 of that amount of time here in Silicon Valley, working with startup companies. And so my presentation this morning is really just a summary of my experience of working with those companies. And my job is really to define startup companies that were going to be the industry subsector leaders. Right? And so some of my clients were included Twitter. So when they were very, very young, maybe 100 employees, and DoorDash when they were still working out of the veterinary office in Palo Alto. Uber when they were still doing the black car service only. Dropbox when they were getting started. So a lot of experience working with entrepreneurs, founders, and companies at a very, very early stage. And what I wanted to do with this presentation is just show you how the accounting and finance function evolves as those companies grow, just what are some of the issues that we need to pay attention to. And just also some learnings along the way that I've sort of taken from all of my time and dealing with companies like that. I have a lot of experience helping my clients do IPOs. So I think in total, by the time I left, I've had my clients do 26 IPOs. So I've got some slides dealing with IPOs and some IPO reviews as well. So feel free to interrupt me as I'm going along here. If you can't understand the accent, I totally understand. So we'll get started here. This is what I wanted to cover. So I'm going to just talk about recent venture capital trends, just so you have an idea of kind of what's happening on a sort of a more macro level with fundraising, both companies raising funds from venture capitalists and venture capitalists raising funds from their partners. So we'll spend a few moments going through that data. Then I'm going to talk about how the accounting function evolves at startup companies. And I'm going to pretty much follow the sequence of how venture capitalists look at companies in terms of early stage, later stage, and then venture growth. So we'll have that sort of lens on as we go through the accounting function. I'm going to talk about the importance of financial statements, primary financial statements when you're fundraising, what other things are important. So we're going to spend a little bit of time on that. We talk about accounting controls, and hopefully nobody falls asleep during that part of that presentation. Got some interesting stories to share about accounting controls and fraud. Then I'm going to get into just some business decisions that as a CEO of a company or as an executive of a company, you really want to be involved in. It's not something you can typically delegate. Now, obviously, there are potentially hundreds of those types of decisions. I'm going to focus on 4 key areas. I'm going to talk about key metrics that end up defining the company. I'm going to talk about revenue, which is arguably one of the most important numbers in the financial statements. I'm going to talk about stock-based compensation, everyone's favorite topic. And then I'm going to talk about taxes, and I'll explain why taxes are really important, even when you're not making any income, when you have losses. I'll spend a little bit more time diving into key metrics because that is very important. And then we'll just end the presentation with just some, I call them common mistakes that I've seen. Okay, so with that, I'll get started. So I wanted to give credit to PitchBook. So we're going to use their data to look at the recent venture capital fundings and trends. And PitchBook is available. I think if you use your college address, you should be able to download the report. They produce a report on a quarterly basis. So we'll have the quarterly funding data. It's As you'll see as we go through here, I've probably maybe taken 10% of the charts that they have in the quarterly reports. So if you're really interested, you can dive down a little bit deeper into all of this. So first, the first chart just shows the historical trend of venture capital funding. So this is the money that startup companies in the US. So we're not just looking at Silicon Valley. This is not global data. We're just looking at US data. This is the money that companies have raised from venture capitalists. So our friends who are just one or two exits up the 280 here on Sandhill Road, the firm that you would recognize. Also corporate venture capitalists. So Google would be a good example. Well, Google has a corporate venture capital arm. Most companies do now, actually. And then also private equity, sort of late stage private equity investors. So this is basically everything that's sort of venture capital related. And so you can see, ironically, right, during sort of COVID and the pandemic, we had these massive amounts of capital flowing into companies. And obviously, as you're all aware, you know, the economy is, particularly the economy that we're sort of interested in here, has taken a little bit of a turn south. You know, we're seeing layoffs that we've never seen before. You know, the amount of capital that's actually been raised by companies has dropped off pretty precipitously, as you can see here. Now, 2023 is just the first quarter, right, but it's probably the lowest quarterly data since 2020. So I almost think of venture capital fundraising as 2021 and 2022 were sort of anomalies, as you can kind of see from this chart. So I would say we're sort of more back to what we were pre-pandemic. So you have two numbers here. You have the number of deals. So those are the number of companies that closed financings with venture capitalists. And then you have a dollar amount, which is the total amount of venture capital funding. That's the amount of money that's flowing into companies. Okay. So that's our sort of backdrop. And then if we look at this indicator, I think is quite helpful. I'm actually not sure how they quantify this, but it's basically a sentiment indicator. And you can see at the high end of the y-axis, right, we have investor friendly. So that means that the financing and the terms related to the financing are much more friendly to venture capitalists, right? So the probably valuations would be lower, right? They're getting a better deal. And then as we get down to the zero mark, that's startup friendly, right? So the startup companies are able to take the terms. No, I don't think 100 million is enough for this company. It should be 200 million. They're in the driving seat, basically. And you can see that's been pretty volatile over sort of this duration here from 2013 to the last 10 years. But one thing you'll notice is that during the pandemic, I don't know where the
Sometimes it doesn't show.
I thought I might have had a pointer, but
it does, but sometimes it just doesn't show.
So during the pandemic, I'll go the old-fashioned way. So you can see companies were in the driving seat, right? Valuations were really high. They were able to get really good terms on their financings. And you know, going into that period, the momentum was with the venture capitalists. So you would see things in venture capital agreements in that period, like they'd put ratchets in, and if the valuations decreased, that they would be able to get more shares. Those types of terms went away, right? So the investors, the entrepreneurs were in the driving seat, and they're like, no, it's plain simple, you know, no frills. That's a very basic financing agreement, generated a higher valuation. So that started to switch back now, right? Obviously, more momentum going back to the venture capitalists. They're more in the driving seat in terms of negotiating financing. And so this other chart shows valuations, but what this chart is doing is it's showing those companies that went public, right? And it's showing a multiple. So oftentimes how companies get valued is if they're private companies, they will look at a public company here and they'll go, I'm just like that company, that public company. And for all public companies, there are valuation multiples that are produced. And a very typical one is a revenue multiple. So you're trading at X times revenue. So 5 times revenue, 10 times revenue, 20 times revenue. And so those public company data points are available. And so private companies would use those for valuation negotiations. Well, they would say, hey, I don't think $100 million is enough. I think it should be 200 million. That's 20 times my revenue. And if I look at this company that's public, they're trading at 20 times revenue, 20 times revenue. So you can see here for public companies, companies that went public in this period, you can see how the multiples were at an all-time high in 2021 and 2022, 10x revenue. Right? So if you got $1 million revenue, you're worth $10 million. $10 million of revenue, you're worth $100 million, and so on. So multiples were probably at a historical high. And look what's happened, right? Remember I was talking about the sentiment has shifted back to the VCs. So now multiples have come down, right? So maybe they're around about five times revenue. So you can see how the valuation metrics have totally changed in a very short period of time. And I took that, if I go back here, I took this 2022, 2023 scenario, and I just mapped it to this. And if I rotate it totally, right, you'll see it's almost the same line, inversely related, correlated to sentiment, right? So you can see in times of low multiples, that means the VCs are pretty much in the driving seat. So I thought it was interesting. It almost fits perfectly. So now we're going to look at different types of startup companies, like where they are in their life cycle and what's happening with that particular type of company. So the first one we're going to look at four. The first one I have up here is quarterly seed, an angel. So an angel is a wealthy individual that invests in startup companies. Seed is when you find out who your friends are. You go and ask your family and friends for money for your business. Right? So these are typically lower rounds of financing, and you can see with seed, which is unusual because normally it's quite a robust area of the market. They actually experience very significant declines in both activity and amounts of money that's being raised. Okay, so kind of the hole that we're kind of in right now is affecting very early stage companies. So seed and angel finance companies. And you can see during the pandemic, they had a great time. Look at how much money they were able to raise. These are billions of dollars, by the way. So I think for seed, we're down to something like 3.6 billion for Q1, which is one of the lowest quarters on record. So we go to the next stage. So at seed and angel, there's no VC involved, right, by definition. But we come to the first stage that a VC gets involved. It's termed early stage. And when you raise money from a venture capital, you raise it in sequences, right? So your very first round of financing is called Series A, preferred stock financing. Your second round is a Series B, preferred stock financing, and so on. So for quarterly stage, this is just Series A and Series B financing. So quite early in the company's life. Right? So again, you can see very similar pattern. Pandemic, fantastic years. Valuations were high, amount of money they were able to raise was high without getting away too much equity in the company. And now for this first quarter, $9.6 billion of financing raised. So quite low compared to historical periods. Deal count is still not bad. 1,197 is the estimated deal count for Q1 for early stage. So if we go on to later stage, so this would be a Series D, Series C, and a Series D financing. So your third and your fourth financing. Probably going back to many of the same investors. Again, it's a similar sort of pattern. You can see only $11.6 billion raised in the quarter in Series C and Series D financings. Compared to all of last year, it was almost a $97 billion year for the full year in financing. So definitely on track to resemble more of the pre-pandemic periods. The very last category we're going to look at is venture growth. So venture growth are those companies that are getting ready they're growing rapidly, they're getting ready to potentially go public. So this would be a Series E preferred financing and above. Okay, so keep those definitions in mind. So only 191 deals, 12.4 billion, not bad. But when you think about that 12.4 billion, anyone familiar with Stripe and how much money Stripe just raised? So we'll talk about that a little bit later, but Stripe is half of that. They raised 6.5 billion. Right? So when you take Stripe out, it doesn't look quite as good, right, in terms of the data. And we'll talk about Stripe later. Stripe had to raise that money because of their delayed IPO, and they ended up with a tax bill on some of their equity awards. And we'll touch on that very, very briefly later. So those are the four categories. The good news for us is, we're in the middle of it all here, right? If you look at this geographic chart, everything's sort of happening in the Bay Area and LA. When we add California together, it's roughly, historically, it's been 45–50% of all the venture capital activity. So it's a great place to be, great place to have your education, great place to start your career. So that trend is still very robust. So a lot of the financing comes here. Okay, so if you think about companies raising all of that money, right, the venture capitalists are investing in it, they need a return, right? They don't put that money in permanently. And the way they get the return is through an exit, right? And an exit is generally one of two things. It's somebody acquires the company, that's an M&A event, merger and acquisition event, right? Or else you go public, right? And you can sell, you can obviously sell your stock at that point once it's a public company. Now, unfortunately, exits have been very, very low. So there's basically been very, very few IPOs. This year, I think it's for technology, venture-backed technology companies, we're probably talking 20 or so. Right? So very, very low numbers compared to the prior periods. So there's no exits, or very few exits. I mean, our expectation would be at some point, most companies are trying to conserve cash because, as we just saw, it's very difficult to raise money and raise money at the right valuation. So I'm assuming at some point companies will run into a cash crunch and they'll sort of be forced by the board into an M&A event. So I would expect a lot of those exit numbers to increase, but through mergers and acquisitions. So if you're a very large company with a lot of dry powder, a lot of cash on your balance sheet, you're probably just waiting for the right time to swoop in and pick up a bunch of these new technologies that you can then, they'll complement your existing technology offerings. So I would expect those corporate M&A departments to be very, 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 very busy, but not a lot going on right now. And this is the other side of the coin. It's, venture capital have to go out and raise money from limited partners, from institutions like Stanford, pension funds and so forth. They will invest in venture capital funds. And so that's a relatively long-term investment. Those funds are normally maybe about 10 years, right? So you can see they hit historic records in well, I guess 2020, 2021, 2022, and it's basically fallen off a cliff, right? And so why is that? Well, if you're a limited partner, and my next slide will show this, you probably haven't seen great returns from your investments, right? All of those companies you invested in through the VC fund that went public, all of those public company market capitalizations are much more than they were at the IPO. You might have some losses in some of those investments. And so you might not be as keen to give more money to a venture capital fund, or maybe you're more selective. There's only certain funds you want to work with. You've got a really good track record.
Are those other ones quarter one earnings? So that
no, thanks for asking that. I should have pointed that out. So all of these slides I've shown you for everything in 2023, they're all full fiscal year. They're all full annual years, right? So I'm comparing Q1 with years. So not a great sort of fundraising, capital raising scene for venture capitalists. And then you add on to that, this is from the Wall Street Journal. So for the first time in quite a few quarters, you can see venture capital funds had a negative rate of return. So -7%. Now this data is a little bit out of date because the way they gather the data and report it. So we're looking at Q3 in 2022, not Q1 in 2023. I would expect maybe more losses to be recognized as venture capitalists, prepare their financial statements and look at their portfolios or assets and decide which ones they need to write down. But again, first time reading that for a while in terms of rate of return. So it's not all depressing. So it's still possible to raise money, and just probably the valuations won't be as high as the ones we just saw. You're probably going to have 5 times revenue, not 10 times. And there's still plenty of, you saw how much money the venture capital firms have raised. So they're sitting on lots of cash, right? So they're looking for good investments. And they're also probably deciding which one of their portfolio companies are going to make it and which ones aren't, and probably directing their attention and their resources to the ones that are going to make it. So I wanted to end on a positive note. So I thought we'd look at the layoffs list. So that's leveling up now. So that's, I'm sure you're all familiar with, a lot of the high profile headlines about layoffs and so forth. This website, I can't really verify the numbers, but it's layoffs.fyi. So they have quite a lot of data on which companies are laying people off. I actually use this. I teach at the business school in Santa Clara, and so I use this for my students. They're all sophomores, and trying to encourage them to become accounting majors. Because when I look at the list of folks that get laid off, there's very few accountants on that list. So that's leveling up. So that's the good news. Okay, so that was the basically venture capital scene.
To add one quick question, when you say return for a venture, it's times revenue. How is that return, that red number, that red bar, how is that being calculated?
I would guess they're calculating it on their portfolio results. So they would look at the valuations on their investments and compare that with the investment base. Yeah. And they'll sell some as they go along, so if you sell an investment that maybe you got it at a very decent valuation, you sold it at some humongous valuation, that would actually push your returns right up. So what they're doing right now is they're revaluing a lot of the portfolios, and those companies we just saw, if they had a high valuation in 2021, it's going to be much lower in 2022 or 2023. They would reflect that loss in their balance sheet. Okay, so we're just going to go through what the accounting function looks like. So I have here seed, and so remember seed was angel, wealthy investor, friends and family. The median amount, these are all Q1 2023 numbers. So the median amount that was raised in a seed funding was $3 million. Okay, the average was 4.7 million. So at this stage, these businesses are very, very young, right? So there's no CFO, because the CFO probably costs $300,000 in cash, right? So they would rather spend the money on engineers, understandably. So no CFO, everything is outsourced. You probably don't even have an accounting staff. You're outsourcing it to. There are many firms that will provide those services on an hours and dollars basis. Maybe you have a part-time accounting manager, one person who comes in 1 day a week, 2 days a week. Everything's manual, right? Hopefully it's all written down in a spreadsheet somewhere. You might be using QuickBooks Online. It's not very sophisticated, right? There's no close cycle. A close cycle, I think you might be aware, is where you close the books every month, and you're pretty rigorous about closing the books and producing a balance sheet, income statement, and a cash flow statement. You're not doing any of that, right? You're trying to survive. You're trying to make your cash last as long as possible. So you're really focused on your burn rate. No controls, right? So you don't have any controls in place around the accounting function or around cash and credit cards and so forth, typically. All you're worried about is making sure the people that work for you, if they get paid and get paid on time, which was a problem for potentially, if you were with Silicon Valley Bank, recently, until that got sorted out. I was just talking to someone at their $42 billion market cap company where they weren't sure they were going to be able to make the payroll that week. So you want to pay your employees, pay your vendors. That's what your focus is on. Okay, so that's typically the seed stage, sort of seed of the pants type stuff, right? Then early stage, remember early stage was going to be our Series A and Series B rounds. Median was 6.2 million. Average was 18.7. So you can see there were probably some very large rounds in that category. I've had clients, I had a Series A client that raised 40 million, right? That's some that have raised just 5 million. So it's kind of all over the spectrum. But now, because you have some venture capitalists on board, the expectation is that you're going to start doing developing the accounting function. So maybe now you have a part-time CFO, someone who's worked with startups. They're coming in, maybe 2 days a week. Typically they're called fractional CFOs. You have some in-house personnel who are full-time. You're still probably using outsourced function. Everything is still really manual. Maybe you have a closed cycle now. It's very informal. Because you have to, because when you go to the board meeting and there's a venture capital investor on the board, they're gonna expect to see a set of financial statements, right? Obviously not to the level of a public company, but they want to see a balance sheet, they want to see an income statement, they want to see a cash flow statement, probably, you know, how are you using your cash? How much runway do you have left at this current expense ratio? So you're applying some discipline. There's more focus on how you're spending your money because you've got board members now. Okay, now we get to expansion or later stage. So it's Series C and D. Median for this quarter was 5.7. Average was 16.4. There's no real trend in these medians and averages for this quarter. Everything was really funky in Q1. So I would expect normally that would be higher, right, for C and D. You've got a CFO now, typically, right? CFO is involved, more in-house personnel. You're starting to automate some of the processes, right? So less manual effort, more formal about your close cycle, and you're starting to put some controls in place, right? So that nobody can walk out the door with all the money you just raised from the venture capital fund. And you're starting to integrate with other parts of the business, with operations. Other people in other departments actually want to talk to you. The sales team want to talk to you. They want to understand how this deal will be accounted for. They're coming to you for advice. So you're starting to be more of a part of the organization. The engineers still won't talk to you, by the way. That happens here. So now we're at venture growth. We're Series E. So for the quarter, again, a little funky with the numbers, but median was 7.4, average was 90.9. So that's probably the effects of the strike deal. Got a full department now. Experienced controller. You're starting to have some disciplines around revenue recognition, income taxes, disclosures. If you're going international, so you might have folks sitting in internationally. Everything's automated. Much more consistent about producing financial statements to the right degree of accuracy, more formal controls, and now you're fully integrated, right? You're really helping all of the other departments. So you have engineering, you have marketing, you have sales, you have legal, you have HR. You're all working together to get equal place at the table. So that's how it. Sorry, I just want to maybe point one other thing. So you are getting a little bit more sophisticated. So this FP&A is financial planning and analysis. That's the team that's looking at forecasting. And by the time the company goes public, sometimes that FP&A team is as big as the accounting team. So you can have a lot of people in that team constantly modeling. What if we do this? What if we do that? What if we cut our price? What if we increase our price? What are competitors doing? Scenario planning. So that's FP&A. Actually, quite an interesting area if you're really into finance. You're building out areas of expertise. So you have a head of tax now who's helping you, and we'll go through some of the tax issues. Foreign exchange, FX. If you're going international, you've got a treasury department. You're coming up with all these policies. The board's weighing in on them. So now you're pretty sophisticated at this point. You're ready to potentially go public within the near future here. So a couple of other things I wanted to just talk about briefly. So for fundraising, very important that you sort of have yourself very well prepared for fundraising. Obviously, there's the business plan component of that, but also is the historical financial statements. So you want to have historical financial statements that you can share with potential investors. Maybe those are even audited, right? Depending on what stage you're at. I would say typically when you're around about Series C and D is when you start talking to the auditors. Sometimes it can be earlier, sometimes it can be later, but probably around C and D, because when you raise money from a venture capitalist, there'll be a covenant in that agreement that says you will have an audit done within X number of days of the end of the fiscal year. And so quite often they'll waive it, but at some point they will say, no, we definitely need an audit. Or sometimes you have a later investor coming in and saying, I'm not investing unless there's an audit. So C and D is when you want to start talking to auditors, getting their advice and really getting the audit done. You'll need financial projections, use of fund statement. Here's how much you want to raise. Here's what we're going to use it for. We're not flying private jets for the executive team. We're actually going to spend it on headcounts and product development. Other things you will have things like a capitalization table. So that capitalization table, who owns the equity? So that's very important for investors. They'll want to see, sometimes called the cap table. Can we see your cap table? Are you capitalized? How many shares have you issued? Who owns the shares? What are the rights that go with the shares? Are they ordinary shares? Are they preferred shares? All of these things will be really important to investors. Any loan agreements, we'll want to know that. I've got existing equity arrangements, oral or written, so it's not uncommon for founders to promise equity to individuals. So, and maybe they're not always papered. So my favorite example, actually, one of my clients is from GoPro. So Nick Woodman, who's the CEO and founder, and this is well documented. I think that it's online, the story, but we were actually there at the time. I think he was driving up and down Highway 1, hawking cameras out of the trunk of his car, right? And so, you know, for cash, basically, at these different shows and going to different search shacks and selling his cameras. And he had promised his friend who was helping him, I can't pay you, but I think it was a college roommate. But if I ever sell the company, I'm going to give you 10% of whatever I sell. And so fast forward a few years, that agreement was never in writing. In my head, like they both have Coronas and they're kind of changing their glasses on the beach or something. And, you know, it was done. And so Nick honored that agreement. So when he first sold his first stake in the company to some private equity investors, later stage VCs, I think it was for 60 million. So his friend came in and collected a check for $6 million. And that wasn't written. But it was important for the investors to know that as well, that agreement was sitting out there. So I went home and yelled at my kids that night and told them to get better college roommates. Right? It didn't work. So written and oral is very, very, very important, right? Because you make all sorts of promises. You're probably all very familiar with some of the high profile fights with founders of some other companies, you know, where they're arguing over who owns what. So you need to get all of that documented. Compensation arrangements. One of the things I would always tell my clients, they would say, oh, I'm not paying myself a salary. I'm like, well, how are you living? And they're like, well, I charge everything to the company. I'm like, well, that's fine, but now you have a tax issue, right? So it's best just to, you know, pay yourself a salary, you know, for a CEO of a company getting started, you know, 200, 250K, the venture capital is not going to bat an eye at that. Just better to keep everything separate, business versus personal, just do it as cleanly as possible. And then board composition. This is more for maybe companies that aren't US based. I worked with some Irish companies from Ireland, and they would put everyone on the board, right? Anyone who ever gave them any money would get on the board. And they'd all have to come off the board because venture capitalists don't like that, obviously, right? You have to have skin in the game. If you've invested a substantial sum of money, you're entitled to a board seat. So they would go through a lot of board recomposition, you know, and telling all their friends, I'm really sorry, you need to get off. Otherwise, I can't get this investment done. And so investors will do their own due diligence, they'll do quality of earnings. And you know, you go from there basically from a fundraising perspective. Any questions on that? Okay, I want to talk about controls, and I also want to talk about fraud, because fraud is very, very prevalent. In fact, it affects most startup companies. I've had a number of my clients that have experienced fraud. And the thing that's just morally repugnant about fraud at this level, I mean, at every level, but at this level, you work so hard to raise some money, right? And then someone just who you trusted, you know, rips you off. Right? And normally there's substantial sums of money. And so it's important to be aware of the types of fraud that you're most prone to, and also how to prevent them, or at least try to prevent them, and maybe detect them on the back end. Okay, so we're just talking about, I'm going to call it employee fraud, misappropriation of assets. There are obviously tons of other types of fraud. You know, there's fraud on your platform. We're not going to talk about that. There's accounting fraud. We just do some accounting shenanigans. We're obviously not going to talk about that. You could have whole separate classes on those. So we're just talking about, it's called misappropriation of assets. So where someone, generally an employee, kind of rips you off. And so here are some common fraud schemes that I saw. And I do want to, this list it's not exhaustive, but it's also not suggestive. So don't be trying these in your spare time, okay? But things that are pretty typical. Personal expenses characterized as business expenses. So business expenses, like to go to a trade show, you're entitled to get that reimbursed. Quite often, we would see, because there's a lack of control reviewing expense claims, that people would put through personal expenses and have that reimbursed. So I went to an ice hockey game, I took a friend, but I told my boss I took a potential customer. and get that reimbursed as a personal expense, masquerading as a business expense. Very, very common, somewhat hard to detect, right? If you have no controls in place. And if you're looking at these expenses 6 months down the line, you know, just forget about it, right? You have to really be on top of it, have rules up front. Expenses never actually incurred, but submitted for reimbursement. So these would be false expense claims. And so let me give you an example, a real example from one of my clients. One of the sales managers for the Western region, basically stopped attending all of these sales conferences. But he would submit expenses with fabricated travel and accommodation, lodging, and meals. So he was a wizard on Adobe Photoshop. So he would say he'd been to these conferences, he would submit an expense claim form for maybe $5,000, $10,000 for that trip, get reimbursed, no questions asked, and did this for years. And he got busted when the CEO was meeting with one of the customers and said, "Oh, this is great. I know you've been seeing Danny every 3 months." And he's like, "I haven't seen Danny for 3 years." He's like, "Well, that's strange, right? I could have sworn he went to this conference." When he checked later, you know, it's true that this person had stopped going to these conferences and was basically just submitting expense plans, getting reimbursed. Maybe it was $50,000, $60,000, which in the grand scheme of things, that individual was probably getting paid $200,000, $300,000. Doesn't seem to make a lot of sense to jeopardize your career for that. But I've seen sales folks, I'm not picking on sales folks, you know, falsify commissions for $10,000 or $15,000 and really put their whole entire career at risk. So it's really hard to understand what motivates people, but that does exist. Falsifying sales to generate commissions. That one, again, see it much less often now, but sales individuals would put together sales contracts. They're commissioned on contracts. For large enterprise software contracts, your commission could be 9%, right? So if you bring in a $10 million contract, you got $900,000 of compensation for that, right? So you can see how you know, there's a large incentive there, and certainly for commissions and sales contracts, there's potentially a lot of fraud. So it will be something like a deal that's not really a deal, right? That they claim commission on, and then by the time you figure out, hey, the customer's under no obligation to pay the $10 million, that salesperson is probably gone. And try getting a commission back from a sales individual is very, very hard. Kickbacks from vendors, tend to see that more in when you're going international. You don't really have an infrastructure in a country, so you're relying on certain individuals in that country to set you up. They may say, "Oh, this is great. You know, we can rent this property in, you know, the downtown of the city, you know," and the landlord might be a family member. So the rent gets severely increased, right? And then the landlord splits the profit with the individual who's working for the company. So a lot of kickbacks, again, hard to police. Gift cards. So you buy a bunch of gift cards for a trade show. Plan is to distribute them to potential customers. Instead, you keep them and you give them to your family and friends at Christmas, you know, or some other holiday. One of my personal favorites, sorry, laptops. So I actually had another client. This company was public too, and doing really well. The engineer, so now it's time to pick on the engineers. The engineer needed some laptops for his team, and that was the theory. Went to the Apple store, bought 10 MacBooks using his own credit card. Submitted that expense claim, got reimbursed by the company. Never distributed the laptops. Kept them in his desk. Took those laptops back to Apple store and got a credit back for the return of the laptops to his own personal credit card. People can be very, very, very creative. Payroll fraud's another one where you're in another country, you've never met all your employees. Not uncommon sometimes to find that there are individuals on the payroll that are actually not doing any work for you. So again, it's all around, you know, putting controls in place and trying to stop that. So those are the most common ones. I mean, things you can do. Corporate credit cards, they just keep them to an amount, right? And there has to be a policy around corporate credit cards. If you want to spend more than X, you have to come get signed off by somebody in charge of the department and so forth. setting approval limits. You can't order, 10 you can't pay for 10 laptops at an Apple store. You have to come and get that requisition through the purchasing department. Improve the hiring process. One of the frauds I saw at a very well-known company, controller, who basically spent, it was like $150,000 in a very short period of time. Did all sorts of things, took friends to the Sharks game in limos, said it was a business expense, flew her mother to Melbourne, Australia for Thanksgiving. No one was checking anything at that company at that point. My favorite one was there was a check that was supposed to the company's attorneys for $35,000, which you just crossed her the name of the attorney out and wrote her boyfriend's name in. And the boyfriend got the $35,000. So all sorts of things. You really have to put some, some controls around this. Sorry, they hired that individual from Craigslist. That was my point. If you want to hire someone, hire them, do your due diligence, right? And that person that I'm talking about, I'm not picking on her, but that was the third time she'd done this at 3 different companies. That was her MO, basically. She knew there were no controls at any of these companies. So really, you can put some procedures in place. Most of these frauds get identified through anonymous tip-offs. In that one case of the boyfriend check and the flight to Melbourne and so forth, that individual had told everyone that she'd gone to Yale, and then some eagle-eyed co-worker pointed out that she's not friends with anyone from Yale and any of her social media accounts, and they kind of busted her that way. So if you're going to commit a fraud, you're probably going to lie about most stuff. So again,
I'm sorry, just on the laptop thing, so misappropriation of assets, essentially. I was wondering how that got caught, because I'm thinking periodic reconciliation between the accounting records and the physical assets.
Yeah, so the assets were never, so that's a good point. Most technology companies, if it's a laptop, they don't treat it as an asset, right? It's a consumable. So if it's say below $5,000, they won't put it into the fixed asset register, right? So it never gets recorded as an asset because they buy thousands of laptops, and some companies do, but most won't. That company didn't. But that would have caught it. You're right.
Do you know how they caught that particular?
I think it was from a fellow colleague. It was someone in the engineering department. And that person obviously got fired right away. Okay, so you work hard to get all this money. You definitely don't want to make it easy for someone to take it, right? I did want to just talk briefly about cyber risk, because there's 2 or 3 things that we see quite often. Some spoof emails. So and I'll show you one example, which was from one of my old clients. I wasn't the partner at the time this happened, although it could easily have happened when I was the partner, but that was a spoofed email from a criminal ring to the CFO. I'll go through that in a little bit more detail. But very simple things, like if you think about like a vendor database, so you have all your vendors that you're dealing with, you have their bank account details in that vendor database, and everything's automated. So when you buy something from them, that goes into the GL, and then when you have your check run or your wire run, you pay them every 2 weeks, right? So one common fraud was companies would get either an email or even a good old-fashioned letter saying, "Hey, it's your friendly vendor here," and it'd be on the vendor letterhead. Just want to let you know, we switched from Comerica. We're now with Bank of America, right? Here's our new bank detail. And it's signed by the person that is their vendor relationship person. And so that comes in at a sort of a clerical level. So that will come into the AP clerk probably. And what do you do when you get a request for a change of bank account details? You edit the record, right? You update the record for the new bank account. And so there's really no oversight. So that person would get the request, they would change it to Bank of America, and then the next few check runs, that check would go into that Bank of America account. And that was not the real vendor, right? That was someone impersonating the vendor. And obviously that gets found out because when the real vendor doesn't get paid for 2 or 3 months, they're like, "Hey, I'm not going to sell anything else to you because you haven't paid me for the